The Singapore market is repricing right now, and $111 a barrel for Brent crude means your REIT dividends are suddenly in the crosshairs. If your portfolio is currently holding highly leveraged assets, the debt wall has just moved 6 months closer. Today, we are opening the books and running the numbers on 3 specific SGX names to see who survives the stress test. One of them is already staring down a massive $198.5 million refinancing cliff. We are applying the strict forensic framework to separate the genuine sanctuary assets from the dangerous yield traps hiding in plain sight. Let us look at the evidence. Look at how the board is shifting before the Monetary Authority of Singapore even finishes speaking. Every yield play is being repriced in real time today. We have Brent crude spiking to $111.43 on the back of supply disruptions in the Strait of Hormuz. At the same time, the S-dollar nominal effective exchange rate path is under active review. The forensic question you need to ask yourself is not whether interest rates are going to move. The real question is whether your portfolio was built to survive the answer either way. If you are holding leveraged assets hoping for a rate cut that just got delayed by imported inflation, the margin of error is completely gone. Taking a snapshot of the macro environment, the Straits Times Index is hovering just under 5,000, specifically testing resistance around 4,989. But the real friction is in the commodity and debt markets. Brent crude is holding that $111 premium due to the Hormuz closure, which is weighing heavily on energy-dependent markets across our region. Meanwhile, the 6-month T-bill, specifically the BS26107X issue, is sitting at 1.47%. What SGX investors are watching closely in today's mass statement is any shift in that modest and gradual S-dollar appreciation stance. Any steepening there directly reprices the cost of capital for leveraged REITs. Moving into the first audit, we are looking at Acrophyte Hospitality Trust. The raw fact here is alarming. Auditors have officially flagged a material uncertainty regarding the trust's ability to refinance a $198.5 million loan due in September 2026. This means the debt wall has not just approached, it has arrived. Looking at the metrics, gearing sits at 42.7%, which is a severe breach of the 35% forensic ceiling. More critically, the interest coverage ratio is at 1.62 times against a 4 times floor. That means the trust is generating just $1.62 of operating income for every $1 of interest owed. When you compare Acrophyte to a peer like CDL Hospitality Trusts, the gap is massive. CDL maintains a materially stronger interest coverage ratio and institutional balance sheet discipline. This is a forensic case study in what happens when gearing drifts. In a forward scenario, just a 10% increase in financing costs at that September refinancing would push that fragile 1.62 times coverage ratio straight toward technical default territory. There is simply no buffer left. The wallet impact is severe. A 65-year-old drawing CPF life payouts and holding these stapled securities faces the potential total loss of their distribution if this refinancing fails. This trap has already closed. Forensic verdict, exit watchlist. This is a textbook forensic call, not a complicated one. We have 3 major thresholds breached simultaneously. Gearing is above the ceiling, interest coverage is below the floor, and the net debt to EBITDA ratio is deep in red flag territory. Any single one of those would trigger a review, but all 3 together, combined with a $198.5 million refinancing due in just 5 months, and auditors using the specific phrase material uncertainty, means the forensic work is already done. The yield might look highly attractive from the outside, but that is precisely how yield traps work. They advertise the high return and they bury the immense refinancing risk deep in the footnotes. Your CPF life payout does not have a recovery mechanism if that distribution gets cut. The gearing ratio does. Turning to our second audit, we examined Koh Brothers Eco-Engineering. The board recently rejected a shareholder resolution to distribute its 54.8% stake in Oiltech International, signaling a clear priority for group liquidity over immediate shareholder returns. When we benchmark the numbers, the balance sheet is genuinely in fortress territory. They are sitting on a net cash position of 19.06 million Singapore dollars, with total debt fully covered by cash. However, the dividend yield sits at a microscopic 0.26%. That fails the 4.7% minimum hurdle by a massive 4.44 percentage points. A perfectly clean balance sheet does not compensate for a yield that cannot even fund a single kopitiam breakfast per $1,000 invested. Looking at the peer context, asset-light operators like LHN are actively recycling capital to close their yield gaps. Koh Brothers deciding to lock in that oil tech stake suggests a strategy of liquidity preservation. In a potential oil shock environment that is a defensible corporate strategy, but it completely disqualifies it as an income play. If we see a 10% downturn in construction margins due to rising raw material costs, group liquidity would compress further, making any special distribution even less likely. For a 45-year-old HDB owner in Jurong trying to build a reliable retirement income portfolio, this confirms the stock is not a payout play. The balance sheet is worth monitoring, but the yield is simply not worth waiting for. Forensic verdict, watchlist, balance sheet only. Koh Brothers presents a split forensic verdict that income investors need to read very carefully. The balance sheet is undeniably one of the cleanest on the SGX mid-cap board right now. We are looking at net cash, incredibly low leverage, and absolutely no refinancing cliff. In a market where a trust like Acrophyte is sitting on a massive debt wall, that kind of institutional balance sheet discipline absolutely deserves acknowledgement. But we have to remember that acknowledgement is not a yield. Missing the minimum hurdle by over 4 percentage points is a gap so wide that even a special distribution would need to be massive to shift the verdict. The board has clearly signaled it is not in a hurry to pay out. A clean balance sheet with no visible path to yield is a watchlist position, not a portfolio position. Our third audit brings us to Capital World. The core principle here is that renovation is not revenue. We have seen 3 years of delays regarding the Mustafa Center in Johor Bahru, confirming a massive gap between promised yield and organic income. The raw fact is that fit-out works have finally begun, with completion slated for the first quarter of 2027. But for a 50-year-old in Toa Payoh with children approaching university age, you must treat that $0.001 share price as a purely speculative position. It has absolutely zero sanctuary characteristics. There is no distribution, there is no income floor, and there is no forensic case whatsoever for inclusion in a retirement portfolio. Forensic verdict, strategic neutral. If you want these exact thresholds and warnings before the market prices them in, Iggy's elite investors get 0-day access to my full Red Zone watchlist. Link is in the description. Now, looking at the institutional analyst chatter today, the entire focus is on the MS monetary policy statement. The directional question is whether the S-dollar nominal effective exchange rate path steepens, holds, or reverses given the Hormuz oil shock feeding into imported inflation. For retail portfolios, the practical consequence is clear. Higher for longer expectations make REITs with gearing above that 35% ceiling incredibly difficult to hold. Banks like DBS, OCBC, and UOB remain the structural beneficiaries of a higher net interest margin environment, provided the oil shock does not tip the broader economy into a slowdown. Breaking down the yield spread calculation for the watch list, we start with a target yield of 4.8%. We subtract the current 6-month T-bill rate of 1.47%, which gives us a risk premium of 3.33%. However, I apply a strict stress test buffer to these numbers. I use a conservative floor of 3.2%, ignoring the temporary market dip in the T-bill. I do not lower my forensic standards just because market rates fluctuate. By adding a mandatory 150 basis points of risk premium to that 3.2% floor, we arrive at a minimum yield hurdle of 4.7%. This ensures any sanctuary assets you hold can actually withstand a return to long-term average interest rates without collapsing your income. Getting to the bottom line, the MA statement is the single metric that matters more than any individual stock we discuss today. If the exchange rate path steepens, the cost of capital for every leveraged REIT on the SGX moves immediately. You need to watch the actual statement, not the subsequent headlines. For our audited names, Koh Brothers has a balance sheet worth respecting but a yield you should ignore. Net cash is a fortress signal, but 0.26% is simply not an income play. Acrophyte is the undisputed 2026 poster child for the debt wall. When auditors explicitly mention material uncertainty regarding refinancing, the conclusion writes itself. Finally, Capital World remains firmly in speculative territory, as commencing fit-out works does not guarantee a future distribution. In a tightening cycle, you have to understand that a sanctuary portfolio is not found in the highest yield on the board. It is found in the lowest gearing. Acrophyte currently offers one of the highest hospitality REIT yields on the SGX right now. It also has a $198.5 million refinancing cliff arriving in just 5 months. That is not a coincidence. That is exactly what a yield trap looks like. The high yield is the bait, and the debt wall is the trap snapping shut. When the market turns, the fire exit for any property trust is its gearing ratio. You need to check that exit and ensure it is clear long before you start to smell the smoke. The reality of this market is that speed is your only true edge. The difference between securing a sanctuary asset and falling into a yield trap is often decided in a single trading session. In a volatile environment where macro events like a Hormuz supply disruption reprice assets overnight, you cannot afford to wait for the dust to settle. By the time this analysis reaches the broader public, the entry and exit windows I am tracking have already opened, and in many cases, they have already closed. The margin for hesitation is completely gone. You must have your forensic threshold set and your watch list prepared before the market forces you to make a decision under pressure. Today, we looked at what happens when yield traps disguise themselves as income plays in a rising cost environment. A looming debt wall can wipe out years of accumulated distributions in a single refinancing event. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. By the time an auditor issues a material uncertainty warning, the smart money has already left the building. Iggy's elite investors get the full red zone watch list and institutional grade cheat sheets exactly when the setup is live, not after the damage is done. Stop being the exit liquidity and check the link below to join Team Iggy. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.